Hey everyone, I am so excited to be back with another dividend stock video. I want to share with you in the video today my top 5 favorite dividend stocks in the entire world right now. I'm going to share each of these 5 stocks in great detail. And then after I do that, I want to go through my strategy. I want to go through in great detail my dividend stock investing strategy and why I believe these 5 stocks are the best 5 stocks in the world right now. Before we get started today, please go ahead and smash that like button, and please also consider hitting that subscribe button because I'm on my road. I'm on the path right now to 75,000 subscribers, and I'm hoping to reach that goal from the video today. Get ready, everyone. It's an exciting video. I have so much more great content on the way as well. So let's get started with today's dividend investing video. Welcome to PPC Ian. This is dividend stock investing for everyone. All right, everyone. So I'm going to jump into the stocks first. Before I even jump into the 5 stocks that are the best 5 in the world, I want to share one of my favorite dividend stocks, StarBucks. And StarBucks, I don't believe it's one of the top 5 dividend stocks in the world right now because of the current valuation. But last year in 2020, this was one of my favorite dividend stocks in the entire world. And so I want to start with this because this stock is going to help transition into the next 5 that actually are the best stocks right now, because there is an element of valuation that plays into all of this. And so check it out on the screen right now. Let's talk about StarBucks. So what's so exciting about StarBucks is I actually bought this stock 30 times last year in 2020. 34 actually if you include the reinvested dividends, because they pay dividends quarterly. So I actually bought this thing 34 times, a staggering 34 times last year. Although there have been 0 net new purchases this year in 2021, except for the one dividend that has been reinvested so far. My best tranche last year was at $51.22, and my overall cost basis in my StarBucks position is $65.63. And so this is a world-class stock, but I'm not buying it right now. I'm not buying it right now because it's trading at $107.32, as you can see on the screen. Based on the forward earnings guidance, the forward earnings estimates from the analysts for this year and next year, it's trading at a forward PE for 2021 at 37, and it's trading at a forward PE next year of 31. And so it's trading really at an expensive level. And the dividend yield right now, the starting dividend yield is a 1.7%. Payout ratio is 63%. And so I don't know if the rate of dividend growth will continue because the payout ratio is getting up there. Nonetheless, the 5-year dividend compound annual growth rate has been a staggering 17.6%. And so StarBucks is this quintessential dividend growth stock. The stock is a growth company, the stock is a dividend company, and this stock is increasing the dividend very quickly. But the reason I start with StarBucks is I love their product. I'm a customer. I'm going to buy and hold this one forever. I wish the share price would go down so I can buy more, but this is not one of the top 5 best stocks, dividend stocks in the world right now, according to me, at least for my personal situation, because of the value. I don't see the value there, and as a long-term dividend investor, value is so important. And as I go through the video today, this is going to unfold more, and you're going to see what I'm talking about. So I want to compare and contrast this with another stock, AbbVie. I'm going from the coffee industry, from the restaurant, the cafe industry, over to the healthcare industry, the pharmaceutical industry. So let's talk about AbbVie. Check it out on the screen right now. This is one of my top 5 favorite dividend stocks in the entire world right now, and you'll quickly see why. This stock is trading at $107.87. The forward EPS estimates are $12.43 this year, $13.80 next year. So the PE ratio, as compared to Starbucks, which is in the 30s, is at an 8.68 this year and a 7.82 next year. And so you can quickly see that the valuation is very low. It's exceptionally low. The starting dividend yield is 4.8%, and the payout ratio is 41.8%. Now, what's so interesting is the 5-year dividend compound annual growth rate is 17.9%, so it's very similar to Starbucks, although I think AbbVie has a greater chance of that trend continuing because their payout ratio is so much lower than Starbucks. As it pertains to AbbVie, my cost basis is $70.27. Many of you around here are going to remember a while back when I was talking about AbbVie. It was on such deep discount. This is before they merged with Allergan. This is when a lot of people were concerned about the concentration of risk in that single drug, Humira. Although things have progressed very nice since then. And so even though my cost basis is $70.27, even at the current price per share of $107.87, I think it's still a great value. And so part of the story here is just because a share price has gone up doesn't mean that it's not a value anymore. Starbucks has gone up so much that it's not a value anymore. AbbVie has gone up, but it's still a value. And so that's an important thing. Now, I include a metric here that I want to share that I don't talk about that much, but I calculate my 2021 forward PE ratio on cost. So if I take my cost basis of an average share price of $70.27 and I divide by the 2021 EPS estimate of 12.43, my PE ratio on cost is a 5.65. Now, I want to share something with you. I actually did an analysis of Tesla. I'm actually going to share that really quickly. I don't have much to say on Tesla other than it's really richly valued. So check it out on the screen right now. So Tesla is trading at $699.60. And with a 2021 EPS estimate of $4.11, 2022 EPS estimate of $5.50, it is trading at a forward PE of 170.22. And for next year in 2022, it's trading at a forward PE of 127. And so we have a stock here, Tesla, and it obviously is growing. Obviously, the stock is going to grow just so substantially over the coming decades. That is a fact in my humble opinion. But it is priced to perfection. We have a PE ratio forward in the $170 range this year, $120 range next year in 2022. Now compare that with AbbVie, which I'm going to put back on the screen right now. Check it out. So AbbVie, my PE ratio on cost, when my average cost is 5.65, and the PE ratio for new shares that I could purchase right now is basically 8.68. So these types of PE ratios with AbbVie are very different than Tesla. And just to hammer home this point, to get the this kind of PE ratio on cost, basically Tesla earnings would have to go up 2,382%. And so what I'm trying to hammer home here, quite frankly, if you put Tesla and AbbVie side by side, these are both world-class companies. These are both exceptional companies. But to be one of the best stocks in the world right now, it's not good enough to be an exceptional company. It has to be an exceptional company that's also on value. It's also on deep discount. Both AbbVie, both Tesla are innovative companies. They're disruptive companies. They're tech-oriented companies. One is in the battery space and automobile space. One is in the pharmaceutical space. But there is no doubt these are both cutting-edge companies. But again, to be one of the best companies in the world for investors like myself, I'm a dividend investor, so I'm not going to be buying Tesla, but putting dividends inside, to be one of the best companies for an investor right now, value comes into play. And when you look at these two values side by side, I don't think it would be possible, even after, say, 3, 4, 5 decades have passed. I don't know if Tesla can catch up. Maybe it can in that amount of time, but it's going to take quite a long-term perspective to come anywhere close to AbbVie. But there are some things that I like and dislike about AbbVie, so let's look at that on the screen right now. As you can see, what I like the most is the PE ratio. I love that. Obviously, I also really like that dividend and the compound annual growth rate on average over the last 5 years of the dividend. What I don't like about AbbVie, quite frankly, is it's in this healthcare industry and reform could destroy it. Also, the Humira, or I guess Humira, is how you say it, patent is going to be expiring in the United States, and hopefully Skyrizi and other drugs will pick up the slack, but that is something that will happen. So far in the expectations from the analysts, they don't see that hurting them too much this year or next, and I think the Allergan merger really helped out diluting Humira's position in the portfolio, and so I think that's really good. But also, what I would say is they need a strong pipeline continually in this type of industry. And so this is an industry where a drug pipeline and a patent, I believe it lasts around 20 years. And so they have to always be innovating to keep up with the times. Whereas Tesla, quite frankly, they can build a world-class brand. Yeah, they have to keep innovating, but they can be more of a one-trick pony versus a company like AbbVie that has to keep innovating. And so obviously for that reason, Tesla will always have a more premium valuation in the market than something like AbbVie. And the drug space, the pharma space always tends to trade a little bit lower for that reason. Let's keep going. Check it out on the screen right now. I want to go through my favorite stock, another favorite stock in the world right now for dividend investors, income-oriented investors. And so check out Altria on the screen right now. I love Altria. This is a sin stock, and it tends to thrive despite no one out there wanting it to thrive, but it just keeps chugging along. It has been ticking up recently. It's been trading as high now as $47.80. It's trading at a forward PE this year of 10 and next year of 9.8. Starting dividend yield is 7.2%. Payout ratio is 75%, although management has said that they're targeting a payout ratio closer to 80, so I think there are more dividend increases ahead. The 5-year dividend growth rate is an 8.8%. Now, worth noting on Altria, my cost basis is $31.38. I have purchased this as low as $15.99. I believe that was my lowest tranche, but my average share price cost basis is 31. And so my 2021 forward PE on cost is a 6.85. Again, we're talking about PE ratios with AbbVie, Altria here, at least on my cost, just staggeringly low. But even for net new shares purchased for AbbVie and Altria, staggeringly low. And so what I like about Altria is it's always on sale. Even though it's trended up a bit here, it's still on sale. I love the great starting yield. What I don't like is it's a business in transition. It has a core product where the volumes are decreasing. It's a US only focus. And a lot of people have this negative kind of stigma associated with Altria because they happen to be in that sin stock industry. But what I'm trying to do here in the video today, as I go through the best dividend stocks in the world right now, is I'm trying to span a few different industries. So I started with healthcare. I started with now sin stocks. But I even showed you last year in 2020, Starbucks was one of the best stocks in the entire world at that time. Now it's gone up too much, in my opinion. But that was in the restaurant space, the cafe space. And so as I construct a diversified dividend stock portfolio, it's important for me to span multiple industries to stay diversified. But what you're starting to see is at any given time in the stock market, I can find great world-class companies that are on sale. And Peter Lynch, for example, in his book, One Up on Wall Street, I did a review of that I'll link to in the description below. He is one of the most successful and celebrated mutual fund managers of all time. He even mentions in his book that he likes the sin stock industry because no one new is coming into an industry like this that's under such regulation and such scrutiny from the government. No one's coming into that. And so even though volumes are declining, the companies continue to thrive through pricing. And I do think there's going to be some upside in this industry, especially if Altria focuses on the long term through new disruptive innovations such as heated products and such as related verticals such as cannabis. And so I think there's a lot of upside optionality with Altria over the long term. And so with all of that, I want to go to my third favorite stock, dividend stock in the world right now. Check it out on the screen. And I want to talk about Kimberly-Clark. And so Kimberly-Clark is my beloved company that makes the toilet paper, and their current price per share is $132.55. Analysts expect them to earn $7.83 this year, $8.20 next year, and so that places their PE in the 16s. Now, this PE ratio is a lot higher than AbbVie and Altria, although it's certainly a lot lower than StarBucks. And quite frankly, it's a lot lower, quite a bit lower than Tesla, and I don't know if Tesla could ever reach this kind of PE. So dividend per quarter is $1.14, $4.56 a year, placing the starting yield at 3.4% and a payout ratio of 58%. The dividend growth on this one is a little slower at 4.4%, but I expect that to pick up because their business is doing well. What I like about Kimberly-Clark is everyone needs toilet paper. We have found that out through the pandemic. They also make tissue. They own the Kleenex brand of tissues, for example, and all kinds of other products, including feminine hygienic products. What I don't like about Kimberly-Clark is Amazon could white label their business. And so one example is when we buy batteries, for example, at our house right now, we just order them on Amazon, and it's the Amazon brand batteries. And those batteries are great. They're cost effective. They work really well. And so could Amazon do the same with toilet paper, with tissue? Absolutely. That being said, my understanding is the diapers that are sold in Costco right now, the white label brand, the Kirkland brand, if you will. I'm not positive about this, but someone in the community told me, and I believe what they're saying, that those diapers are fueled by Kimberly-Clark. And so the fact of the matter, if Amazon does get into the diaper business, does get into the paper towel, the toilet paper business, could they partner with someone like Kimberly-Clark and white label the product but have Kimberly-Clark provide it? Absolutely. And so I think there could be a win-win out of a situation like that. But again, one of the reasons Kimberly-Clark is one of my favorite dividend stocks of all time right now is the fact that it's one of the best companies in the world. It always has been. It's on my ride or die, if you will, dividend stock list, but it also happens to be on discount. It also happens to be on sale right now. And when those two factors collide, that's what makes it the best in the world for me right now. Let's keep going. I want to move on to my next stock. So we're moving now from consumer packaged goods type products, consumer household products. I want to move on to another type of consumer packaged goods, but in the food space. So I'm moving across different industries. Check it out on the screen right now. I want to talk about General Mills really quickly. So General Mills right now is trading at a price of $58.13. The forward analyst estimates place it at a PE right now in the 15s. And so the dividend yield on a starting basis is 3.5%. It has a very low payout ratio of 54%. And I think the 5-year dividend compound annual growth rate is going to pick up because they successfully digested the Blue Buffalo pet food acquisition, and the dividend growth was on halt. The dividend was just staying flat while they digested all of the debt from that acquisition. The acquisition is doing better than they thought, and so dividend growth is back. And I think they will continue to grow the dividend over time. What I really like about General Mills is it's a successful, they showed a successful Blue Buffalo acquisition, and Blue Buffalo is premium pet foods, and everyone these days loves their pet, and pets are becoming more and more prevalent across the United States. A lot of people like pets. A lot of couples are opting to have pets instead of children, or delay the decision to have children and instead having pets, or both. And so I think that's a great industry to be in. And I think Blue Buffalo differentiates themselves having a premium quality about them. Dividend growth is back sooner than expected. What I don't like is they do have some legacy brands such as cereal, such as Cheerios, which I personally enjoy. But the question will be, for newer age brackets, for younger generations, will those types of foods go out of style, and will they stay with the times? And so obviously a company like General Mills, it will always be trading at a lower PE ratio than more innovative companies like Starbucks and Tesla. Starbucks commands a higher PE ratio even last year when I bought as low as $51 because their mobile app, for example, is so innovative. They were pretty much the leader in mobile payments. They started the space with their mobile app, ordering Starbucks coffee on the mobile app. They will always be trading at a higher valuation. But that being said, a forward PE on Starbucks of 37 versus a forward PE on General Mills of 15, Starbucks would have to grow quite a bit to catch up with General Mills. And is it even possible to close the gap? I start looking at things through that lens, and that's why General Mills, for me, is one of my favorite dividend stocks in the world right now in 2021, and I absolutely love it. I want to go on and talk about a peer of General Mills. This one is in the consumer packaged goods food industry as well, but it's a little different because General Mills is more about pet foods and kind of just household breakfast cereals, and they own Annie's mac and cheese too. I want to move from that to the snack food category because the snack food category is very popular with younger generations such as millennials who want to eat snacks throughout the day. And who doesn't enjoy a good salty snack? And so with that, check out Campbell's Soup on the screen right now. Campbell's Soup is currently trading at a price per share of $47.44. The PE ratio, like General Mills, is in the 15s, and the dividend yield is a 3.1%. Great payout ratio of 48%. Room to grow the dividend. Dividend growth has been slower at 3.5%, but it will pick up. And the reason for that is Campbell's Soup recently went through a few years of rough management. They redid their upper management. They got rid of some bad acquisitions. They're back on the right path. And so I think things are going to turn around for Campbell's Soup here. I have some exciting comparisons to make, so check it out on the screen right now. And what you can see is basically to catch up with Campbell's Soup, Starbucks would have to increase earnings by 140% to get to Campbell's Soup current valuation. Tesla would have to increase earnings 995% to get to a similar valuation as Campbell's Soup. For me, when I look at this just objectively, the reason an investor would even consider buying Starbucks or Tesla at current valuations over Campbell's Soup is just the belief that the earnings per share for those companies over the long time will grow a lot quicker than Campbell's. And at some point, the EPSs, the PE ratios on cost, if you will surpass Campbell's Soup. You remember the PE on cost examples I gave earlier in the video for AbbVie and Altria. The investors buying Tesla here, looking forward maybe 20, 30 years, thinks, hey, my PE ratio on cost, it's going to be better than the PE ratio on cost that I could get for buying Campbell's here. And that's why an investor would buy Tesla. Personally, looking at just this objectively, I'm not so certain that will ever happen, and that's why as a value investor, something like Campbell's Soup, it's a world-class company, one of my favorite companies of all time, and it's trading at deep discount. That's why it's one of my top 5 favorite dividend stocks in the world right now. And so let's keep going. Check it out on the screen right now. And what I want to talk about is what I like. And so it's a snack food company. Snack foods are hot. I think it will always be hot. They successfully turned around the company. They have some iconic brands like Goldfish. They own Pepperidge Farm. What I don't like is historical mismanagement. And quite frankly, what I don't like is shareholders have been waiting, and it's time to make something happen, Campbell's Soup team, if you're listening. With all of that, please give a thumbs up if you enjoy the video so far. I have a lot more to go through, but if you enjoy it so far, give a thumbs up, hit that like button, and actually, just a quick note for all of you. I do have another YouTube channel now. It's about cryptocurrencies and earning passive income on crypto. I will link to that in the pinned comment below if you want to check that out. It's just called PPCE in Crypto. I hope to see you subscribing over there. I have some cool videos, 3 videos over there already. And if you want even more content, I have a ton of videos on Patreon. Check it out. I'll link to that in the description, the pinned comment below. If you check out my Patreon, and sign up, you will join 136 patrons over there and unlock, I think I have 23 videos already on Patreon, and I just uploaded one today that actually discusses a challenge I'm going through right now, how I deployed too much money too quickly recently in the stock market because I got a bit overzealous with some of these exciting values out there. So check me out there as well. And please don't forget to subscribe. Help me reach that 75,000 subscriber goal. It would mean the world to me. I love you all. With that, I want to move into part 2 of the video today. I have a lot to share right now about my strategy, and this is exciting stuff. This really is exciting stuff, and it answers a lot of questions I'm getting on my Facebook group. So check it out on the screen right now. And the first thing I want to do is basically go through the best dividend stocks in the world right now and talk about the importance of market timing and the case for individual dividend stocks. And a lot of what I'm saying here, it's going to help illuminate why I selected the 5 stocks I just shared. And so first I want to talk about mutual funds, index funds, ETFs versus individual stocks, and why I like cherry picking value. And so fact, when an investor buys an index fund or ETF, even a dividend focused ETF, that investor is getting all of the stocks in the ETF at the same time. They can't just cherry pick one stock or 2 stocks. What I'm talking about in the video right now is cherry picking. I presented 5 stocks that I like now that I can cherry pick. I don't have to buy the stocks that are overvalued like Starbucks. I love Starbucks, but it's overvalued. I could instead buy General Mills, which is a good value right now, in my humble opinion. And so that is one of the challenges with the dividend focus ETF is if I buy that right now, it includes Starbucks and General Mills. And so I get kind of one stock overvalued, one under, nets out at kind of fairly valued. Let's keep going. Check it out on the screen right now. And so unfortunately, the fund's holdings, they really will fall into 3 buckets: overvalued stocks, fairly valued stocks, and undervalued stocks. Now, I'll tell you, thankfully, index fund and ETF investors, they do get a few good buys time to time, just they have to wait for the overall market to absolutely plummet, and then they can kind of have their stocks fall into the first bucket. But in general, right now, for example, with a dividend-focused ETF, you're going to have stocks that are overvalued, like Starbucks, fairly valued, and undervalued. And so personally, I really like individual dividend stocks because I can focus on bucket 3, the undervalued stocks. Now, on an ongoing basis, do I always buy undervalued stocks? No. Sometimes I will buy stocks that are fairly valued because I'm just looking to up the allocation of a certain position in my portfolio. But if we're going about things, and sometimes it's hard to force yourself to do things just the perfect way. But if I were always the perfect dividend investor, honestly, I would just only look at the ones that are undervalued at any given time. But the reason I like individual dividend stocks instead of an ETF for my personal situation is I do like this fact that I can cherry pick the best values at any given time. So with that, let's keep going. Check it out on the screen right now. And so what I want to do now is I want to move to a different topic, which is active versus passive investing. And so as a fact, the financial media says that dollar cost averaging into high quality index funds and ETFs on a fixed monthly schedule is the way to go. Honestly speaking, I think this is a fabulous strategy. It's not for me, but I don't see fault with it. I think this type of strategy, especially with a dividend and value-focused ETF, it can free up a lot of time for the investor so the investor doesn't have to spend painstaking time like I do researching stocks all the time. Now, thankfully, I do what I do because I love managing finances. I love money. I love thinking about stocks, analyzing stocks. It's just fun for me. I really enjoy it. I have a passion for it. Hopefully that comes through on the channel. If you do as well, put in the comments below. But I know a lot of people, they don't want that. They want to free up some of their time. And so honestly, I can't fault anyone for doing index funds, ETFs. I think it's a fabulous strategy as well. And I think a lot of investors blend them, individual and ETFs, for example. I just happen to go all individual stocks. Let's keep going. Check it out on the screen right now. And so, however, I believe that honestly the financial media oversimplifies the matter. They share charts and studies that say, oh, hey, it's impossible to beat the index. The fact of the matter is those charts, they miss a lot, and they miss the point that an investor can be selective on when capital is deployed and also which stocks capital is deployed. And so the charts, they just kind of look at all the stocks and they just assume, hey, you're evenly deploying money over time. But the fact of the matter is we don't have to evenly deploy money over time. We can pick moments in time when we want to deploy money, just like Warren Buffett, for example. I give him some criticism sometimes, but honestly, Warren Buffett has it right. Years will go by and he won't deploy money. Then a good year comes when there's value, he will deploy money. And so the fact of the matter is you don't have to evenly deploy money over time. I think this is something that these charts and these studies get wrong. And the other thing is that the charts and studies get wrong is it's possible to cherry pick very few stocks that are on exceptional value. Stocks like AbbVie, for example, or Starbucks, in my opinion, the last year in 2020. And so let's keep going. Check it out on the screen right now. And so the journey is not linear, and the investor has power of choice. And so it's my thesis, and I could be wrong, but so far this thesis has held up in my real world experience pretty well, that I believe it's possible to beat the index, even owning stocks, quite frankly, in aggregate that may not beat the index. Because I can purchase such stocks, I can cherry pick them during times of deep value. For example, my PE ratio on cost on AbbVie right now is 5. And so I think it is more possible to beat the index by owning the best companies in the world that tend to keep up with the index or even surpass the index, and purchasing them at the best possible times. But I think, quite frankly, even buying stocks that might lag the index a little bit, if the investor is savvy enough to just buy them when they're kind of on deep discount sale, that creates a lot of opportunity. Again, the investor's journey, it's not linear. The investor's journey, there's an element of cherry picking, and I think these things are very important. Give the individual investor a lot of power. And so with that, let's keep going. Check it out on the screen right now. And so the best stocks in the world right now, if you were to just ask someone, what are the best stocks? The typical response would be, oh, it's the stocks I've heard of: Apple, Tesla, Alphabet, Coca-Cola, Procter & Gamble. That's what a typical person would say. But for me, I would say, yeah, it has to be those types of stocks, those names, those stocks that are just incomparable, that are just amazing. But value matters too, and value matters most. And so with all the great companies out there, the actual best stocks in the world are the ones on the short list of stocks that have incredible fundamentals. And I just mentioned some like Procter & Gamble, but they also have to be on sale. In my opinion, the stock market is not efficient. In my opinion, the savvy investor has opportunities to selectively place capital and win. And so some people will say, but Ian, why do the mutual funds lag the market? Why can't the mutual funds keep up? And I'll tell you why the mutual funds can't keep up. Look on the screen right now. And even the best mutual fund manager of all time, Peter Lynch, in his book, One Up on Wall Street, he shares how so many mutual fund investors, managers, for example, they're up against very difficult standards. They have a short list of stocks they can buy. They can't buy smaller stocks. They have to do certain things. And so they have to have a certain number of holdings in the fund. Mutual funds can't beat the index because they're up against quite a lot. In my personal opinion, I am managing a mutual fund of 50 stocks. I'm managing it. That's my portfolio. It's my own mutual fund. And I'm attempting to at least keep up with the index and have a much bigger component of cash flow. But over the long run, the back testing I've done has shown that my strategy should beat the index, and historically back testing it has. In recent years, not quite so well, because tech stocks have just been surging and I'm a bit underweight tech, and I'm working on that right now. That's one of the reasons I've been adding to my Apple position recently to bring it up to size a little bit more in the portfolio. But I think mutual fund managers are at a great disadvantage, but I think smaller investors, like Peter Lynch says, are at a great advantage because we can selectively time the market, cherry pick value, and we are not beholden to a annual report that goes out. For example, mutual funds, they have to window dress the annual report. If there's a loser in their portfolio, they get rid of it so the investors don't see it. If you're a small investor and there's a loser and you liked it up here and now it's down here, the small investor like myself can average all the way down and really enjoy the benefits of doing so. Let's keep going. Check it out on the screen right now. And so some people will say, Ian, but value, it never goes up. Only the tech stocks go up. Classic example is Altria. It's gone nowhere. It's just been hanging around $39, $40, although now, as you saw earlier today, it's finally creeping up. I would say this is great. Dividend investors invest for cash flow, and the longer the stock stays down, the more time to accumulate. But my thesis, what I will say is, in the long run, I do believe the stock market is efficient, and I do think it will value and unlock all of the value that is there, and it will also, stuff that is overvalued, they will come down. And so I would say Short run, stock market is inefficient. Long run, it is efficient. And I think, honestly, as technological advances pop up and the market gets more automated, there's more automated trading, this and that, there's going to be less of these opportunities that I see right now in deep discount. I think looking 20, 30 years out, but right now there are these values. I would say it's going to be a long time to tell if my thesis is right, but looking out in the long run, I do think that some of these value stocks that I mentioned today that happen to be world-class companies with value are going to outperform. And I think some of these companies that might be a little bit overvalued, maybe they'll still trend up, but I think some of the growth, it could slow because it's going to be hard for Tesla's earnings to catch up to the current share price. And now, I want to say I don't wish Tesla or Tesla shareholders any wrong. I actually hope they do really well. And my eyes have been opening recently. I've been looking at some of these Tesla products. They're really amazing. And I've kind of changed my mind on that matter. I shared that actually on my Patreon, that my thinking on Tesla has evolved, and I'm really excited about their cars and their Powerwall. And so that's something that potentially I would look into those products in the future. But right now, as a dividend investor, I got to save my money for stocks because those Tesla products are awfully expensive. And so moving on, check it out on the screen right now. I want to say in practice, I don't always follow my strategy. Like I said, I bought Apple recently. It's not a value right now. But the fact of the matter is I do that because I want to bring things up to size. And sometimes even if you know what's right, it's sometimes impossible to 100% follow your strategy. But what I have found for dividend investors, the best stocks in the world, they change each year because I have a list of 50 stocks that I think are the best stocks for me in the whole world. But within that list, there's only a subsegment each year that I really want to focus on because the best ones in the world right now are the ones that also have the value. All right, everyone, if you enjoyed the video today, please share what you think in the comments section below. Please smash that like button. It means the world to me. I can't wait till I hit 75,000 subscribers, and then it's just a short road to 100,000 and that silver YouTube play button. I cannot wait, and I am going to keep working as hard as I can to reach that goal. Please subscribe. Check me out on Patreon as well. Check out my new YouTube channel, PPCE and Crypto. I can't wait to see you there as well. Before I leave today, in terms of full disclosure, I'm long the stocks mentioned today. I am personally long Apple, ticker symbol AAPL, Coca-Cola, ticker symbol KO, Procter & Gamble, ticker symbol PG. I am also long Starbucks, ticker symbol SBUX. I am long Campbell's Soup, ticker symbol CPB. General Mills, ticker symbol GIS. Also, I am long Kimberly-Clark, ticker symbol KMB. Altria, ticker symbol MO, and AbbVie, ticker symbol ABBV. I own all of those in my personal dividend stock portfolio. In terms of a friendly disclaimer, today's video is not investment advice. I'm not a licensed financial advisor. Today, I'm just sharing my journey on YouTube for fun and entertainment. If you're going to go out and invest in the stock market or anywhere else, please consult a licensed financial advisor first. I'm just sharing my journey here on YouTube for fun and entertainment. It's possible to lose a ton of money in the stock market. Proceed with caution. If you enjoy my videos and want to show some support to the channel, I also have a store with a lot of custom merch, like the sweatshirt that I'm wearing today. I love my custom merch. Check it out. I'll link to that in the pinned comment below. I love you all. Thank you so much for being here. It means the world to me. I'll see you in the next video.